30 things you may not know about reverse mortgages. Number 1. You remain the owner of your home. A common misconception of reverse mortgages is that the lender takes ownership of your home. This is false. You continue to maintain ownership of your home, as long as you comply with the terms of the loan and pay your property taxes and homeowner's insurance. Number 2. There are no monthly mortgage payments required from you. One of the most attractive benefits of reverse mortgages is that payments are made to you, as long as you live in your home. This is quite different from a traditional forward mortgage where you must pay funds in a monthly amount. With reverse mortgages, you receive funds. The loan is repaid when you sell your home, move to another primary residence, or when the last borrower leaves the home. Borrowers remain responsible for paying property taxes, homeowner's insurance, and for home maintenance. Number 3. You are protected if the housing market declines. The reverse mortgage loan is insured by the federal government. With federal insurance comes greater security. If the loan ends up amounting to more than the value of the home when sold, government insurance will cover the difference. This means that the loan will be paid in full using only the proceeds your home sells for, and no more. Number 4. You may choose from several options of disbursement. Each individual senior has different needs. Thus, there are different disbursement options to cover different needs. This includes the choice to receive funds in a full or partial sum, a line of credit, monthly payments, or a combination of any of these. Number 5. Flexibility. The Reverse Mortgage Home Equity Conversion Mortgage, HECM, is a tremendously flexible product that can be utilized in a variety of ways for a variety of different types of borrowers. Households who have a financial need can tailor the product to distress their finances. Households with adequate resources might consider the product as a financial planning tool. Number 6. Stay in your home and improve your immediate finances. The key to a reverse mortgage home equity conversion mortgage, HECM, is that it enables you to live in your home for as long as you want with absolutely no monthly mortgage payments. Borrowers must remain current on property taxes, homeowners insurance and WA dues, and, in many cases, you can also get access to money to use for any purpose. Number 7. Low risk of default. Unlike a home equity loan, with a reverse mortgage home equity conversion mortgage, HECM, your home cannot be taken from you for reasons of non-payment. There are no payments on the loan until you permanently leave the home. However, you must continue to pay for upkeep and taxes and insurance on your home. Number 8. No downside. With a reverse mortgage home equity conversion mortgage, HECM, you will never owe more than your home's value at the time the loan is repaid. Even if the reverse mortgage home equity conversion mortgage, HECM, lenders have paid you more money than the value of the home. This is a particularly useful advantage if you secure a reverse mortgage home equity conversion mortgage, HECM, and then home price declines. Number 9. Tax-free as a reverse mortgage home equity conversion mortgage, HECM, is a loan. The money from it is typically tax-free, whether you receive it as fixed income or in a lump sum. Number 10. No restrictions how you use the funds from a reverse mortgage home equity conversion mortgage, HECM, is up to you. Go traveling, get a hearing aid, purchase long-term care insurance, pay for your children's college education, or simply leave it sitting for a rainy day. Anything goes. Number 11. Flexible payment options. Depending on the type of loan you choose, you can receive the reverse mortgage home equity conversion mortgage, HECM, loan money in the form of a lump sum, annuity, credit line or some combination of the above. Number 12. Home ownership. With a reverse mortgage home equity conversion mortgage, HECM, you retain home ownership and the ability to live in your home. As such, you are still required to keep up insurance, property taxes and maintenance for your home. Number 13. Preserve and increase the value of your home equity. If you take your loan amount as a home equity line of credit, then this reverse mortgage home equity conversion mortgage, HECM, line of credit grows annually. This locks in your current home value, and your reverse mortgage home equity conversion mortgage, HECM, line of credit over time might be larger than future real estate values if the market goes down. Number 14. Federally insured. The Home Equity Conversion Mortgages, HECM, is managed by the Department of Housing and Urban Affairs and is federally insured. This is important since even if your reverse mortgage, home equity conversion mortgage, HECM, lender defaults, you'll still receive your payments. Number 15. Can preserve your wealth. Depending on your circumstances, there are a variety of ways that a reverse mortgage, home equity conversion mortgage, HECM, can help you preserve your wealth. Some financial planners are recommending reverse mortgage or home equity conversion mortgage, HECM. Number 16. Better health due to lower levels of stress. Money problems are a major source of stress. According to the American Psychiatric Association, over 70% of adults worry about money, and that can take a toll on your physical health. Financial stress is linked to physical conditions such as diabetes, heart disease, migraine headaches, and poor sleep. Not only that, money worries can cause anxiety and depression, robbing you of peace of mind to enjoy your life today. Taking steps today to get your retirement planning on track is an important step in your overall financial wellness, which can only be good for your physical and emotional health. Number 17. Plan for taxes. As you work on your investment strategy, it's important to understand that depending on the investment types, you may have tax ramifications when you are ready to withdraw that money after retirement. Consider a few key questions and allow them to dictate your retirement planning. Should you pay taxes now in return for lower taxes when you retire? Will taxes be higher when you retire? Do you wish to defer, at least, some of your taxes until retirement? How can you maximize your investments to minimize taxes now and later? The sooner you begin planning for post-retirement taxes, the easier your investing becomes. Number 18. Big picture context helps you make better career and financial decisions. Life hands you a lot of important questions as you get older. More often than not, the answers aren't always black and white. For example, should you stay with your company or start your own? Does it make sense to pursue a new degree or professional path late in your career? Should you pay for your child's college or fund it another way? Can you afford to buy a vacation home at the beach? These life decisions have a major impact on your finances and can't or shouldn't be made in a vacuum. Knowing where you are with your retirement plan gives you essential context to make big decisions with confidence. Making better financial and life decisions is another major reason why retirement planning is important. Number 19. Enjoy a happier marriage. It's no surprise that money issues are a leading cause of divorce. Mismatched financial priorities, high levels of debt, and the inability to work toward a common financial goal all cause marital strife. When you and your spouse are on the same page with retirement planning, you eliminate some major sources of discord in your marriage. Take money out of the retirement equation and you can focus your efforts on more exciting decisions such as where you want to retire. Hiring a financial advisor who can provide objective, non-emotional counsel may do wonders for your marriage. Maintaining a healthy relationship with your spouse can be a great reason for why retirement planning is important. Number 20. Forced early retirement won't be so scary. Retiring at 55 is great when it's part of your plan. Being forced out of your job early isn't. Unfortunately, nearly half of all current retirees aren't retired by choice. Most were laid off or forced to leave their jobs, and a smaller number had to leave work prematurely to care for an ill or aging parent or spouse. If you have to leave work before your expected retirement age, you'll be in a much better position if your retirement plan is already in place. You might not have your nest egg completely built up, but having money set aside for retirement gives you more options and time to adjust your plans if you need to retire early. Number 21. You won't worry about being a burden to your kids. Have you heard of the sandwich generation? That's the name for the group of people who are simultaneously supporting their children and one or both parents. About 44% of middle-aged adults with children at home have at least one living parent who could potentially need care. 15% are full-fledged members of the sandwich generation who financially support both parents and children. A comprehensive retirement plan includes saving for medical costs and potential long-term care costs. When you know your expenses are covered, you won't have to rely on your family to fill the gap. Number 22. You can be a really cool grandparent. A good retirement plan not only keeps you from being a burden to your kids, it gives you the resources to be an amazing grandparent. Wouldn't it be nice to take the entire brood on an annual trip or host your whole family at your spacious vacation home every year? Even if your grandparenting goals are a bit more modest, having adequate income means you can visit more often and be present for all their milestones and special events. It gives you the resources to buy those special birthday gifts or help cover the costs of their college tuition. Money won't be an obstacle to a close relationship with your grandchildren. Number 23. Continue your legacy of charitable giving. Most people cut their living expenses in retirement but continue their habits of charitable giving, according to a recent study. We see this a lot with our clients. If you've been a generous giver during your working years, it's probably important to you to continue supporting your church and favorite charities once you leave your job. Financial planning for retirement can optimize your charitable giving 3 ways. It helps provide the income you need for charitable giving throughout your life. It ensures your estate plan aligns with your legacy goals. It allows you to reduce your tax burden, if appropriately structured. While beyond the scope of this video, a qualified charitable distribution strategy can be a powerful strategy to help maximize your charitable donations and reduce taxes. Number 24. Avoid running out of money. Few things are more frightening than the thought of outliving your resources. Even a seemingly adequate portfolio can be inadequate for your needs if it's not managed properly, especially if market conditions change. Retirement planning is important because it can help you avoid running out of money in retirement. Your plan can help you calculate the rate of return you need on your investments, how much risk you should take, and how much income you can safely withdraw from your portfolio. Working with a financial advisor for retirement means you'll have the right amount saved when you finally leave work and that your assets will be managed in a way that protects you against the unexpected so you're never caught short in a downturn. That's the ultimate peace of mind. Number 25. Ensuring your quality of life. Taking charge of retirement planning sooner rather than later gives you the best foundation to make sure you can afford to retire. Also, it maximizes your chances of building up sufficient funds to maintain the lifestyle you want to live. As you shift from the accumulation, earning phase into the distribution, no earnings phase of your life, you'll need to have enough savings, investments, and/or assets to cover all your expenses. It's common for people to underestimate their retirement requirements, when they might need as much as 80% to 90% of their pre-retirement income to stay comfortable. A detailed retirement plan can incorporate sources of income, projected expenses and savings, and expected asset growth. It should be modeled on realistic figures for future cash flows so your expected retirement income is as accurate and realistic as possible. Start with a clear, focused retirement plan based on your goals and desired retirement living standard, and you can begin to save and invest wisely now, ensuring you have enough when the time comes. Number 26. The power of time and compounding. Thanks to the magic of compounding and time, a near impossible financial goal requiring significant effort could be achieved with minor compromises and inconveniences today, if you start earlier. As an example, skipping your weekday coffee, spending $5, 5 days a week, compounds monthly to a staggering $132,204 at 7% over 30 years. Now is the best time to start saving so you can leverage the longer time horizon for compounding. Rather than putting off saving and investing for retirement until the kids have grown up or you've paid off the house, start earlier and the journey could be much easier. The more time you give yourself to save, the less effort you'll need and the lower your risk is for missing out on your ideal retirement lifestyle. Number 27. Seize wealth-generating opportunities at each life stage. The earlier you start with exploring wealth-generating options, the more flexibility and choice you could have when it comes to growing your assets. These opportunities can change at different life stages, when your tax profile changes and when your risk tolerance changes. For example, if retirement is 30 or 40 years off and you have extra money, you could be justified in investing in riskier investments with potentially higher returns. Working with an experienced financial planner enables you to explore different wealth-generating opportunities and investment products, from annuities and shares to property. Number 28. Mitigate against unexpected events. Unexpected events can happen at any time, and starting early with retirement planning gives you a good foundation for mitigating and recovering from these unexpected circumstances. Integrating retirement planning early into your ongoing financial planning could better protect you against financial catastrophes and other unforeseen circumstances. For example, major trends like inflation and economic downturns can severely erode or devalue your investments, but if you allow enough time for recovery, you could still achieve your retirement planning goals in time. On the other hand, some people could overestimate their ability to continue working, when they might need to leave the workforce due to injury, poor health, or sick family members. A comprehensive retirement plan, implemented early, could provide more scope for addressing these unexpected disruptions. Number 29. Take advantage of government incentives. While benefits like the age pension alone are unlikely to give you a comfortable retirement, they can be used to complement your retirement strategy. The earlier you start, the more you could stand to gain with approaches like salary sacrificing into your super and government co-contributions. These superannuation boosting and tax-effective strategies can help you maximize your superannuation balance and have it working harder for you earlier. Number 30. Stay focused. Retirement planning is all too easy to put off, particularly if retirement seems a long way away and you have more immediate priorities like home loan repayments, holidays, and a growing family. However, if you integrate retirement planning into your financial planning arrangements as early as possible, you can stay focused even with competing priorities. With a written, specific retirement plan, you can find it easier to balance your immediate lifestyle expenses with saving more and building wealth for retirement. You can make adjustments as laws, opportunities, and other circumstances change, to ensure you stay on track. Are you wondering if a reverse mortgage is right for you? Contact us today for your no-obligation reverse mortgage evaluation. David Nute, NMLS number 91704. 334 West Washington Street, Sequim, Washington, 98382. Give us a call by dialing 800-562-9514. Creative Retirement Planning, Inc., NMLS number 1175810. For more reverse mortgage videos, consider subscribing. If there is someone you know who needs to see this, please share the video. If you found this video useful, give it a like. Thank you for watching.